Hello everybody, my name is Stefan Friedrichowski, as always on Thursdays. Today we have the 29th of September, 11 o'clock as usual, and of course we have the next webinar of developing superb trading strategies in cooperation with Argus FX, and thanks to Argus to make that kind of webinars possible. Yeah, you know, that you can reach me always via my email address here listed already, Friedrichowski, complicate last name, at argusfx.com. And whenever you have some questions, just send me an email and we can discuss via Skype or discuss via email, no problem. So you are always welcome to ask some questions. Yeah, the topics for today. Oh, let's first, because it was a question I always get. That is a question: how can I have access to the recordings? And by the way, that's quite easy. You see already on my slide the link, but let me post it here as well. Just a second. Now we have it. So yeah, you have access to my YouTube channel, and there you can find the recordings as well. Yeah, topics for today. Besides the question and answers from last week, there are two of them which I will discuss briefly. I want to introduce today another concept, and that kind of concept deals with the so-called entropy. I assume that not everybody is familiar with entropy, either from education in physics or chemistry or whatever reason, or information theory. So I will discuss it a little bit more in detail. But I have to say, if we remark for this webinar, it might be a little bit more mathematically than usually. So keep in mind, if you think about a next week webinar, then we will do much easier stuff like so-called seasonal trading. So today, I hope it will not be too complicated, but I will guide you through the overall concept. Then the next step is when we understood what means entropy and how we can use this kind of concept for trading, then I will show you how I personally really set up a strategy based on two elements, and the two elements I use is the class trading concept we have had in the last couple of webinars, and now combined with this entropy. And that is a very promising approach because we can use the one to select indicators, that is the entropy, and we can use the other one, the class trading, to have that kind of concept, meaning that we look for different classes and decide individually for every class how to trade that specific class, and that we can combine. And I show you some first results on this kind of strategy. Up to now, I have only some results for a few Forex pairs, but computer is running and checking exactly that kind of strategy. So let's say in 2 weeks, I can really share with you the complete results. Last topic, as now usual, I will review two ongoing strategies in a little bit more detail, and that will be the last one. Yeah, let's start already. So first topic or question. There has been a question coming via email, and I hope I helped that guy already directly with my answer. And the question was related to MT4, and yeah, it was simply, how can I set up profiles in MT4 in order to switch, for example, between different kind of screens? And that I will demonstrate here directly on my MT4 account. And the second question is related to Forex trading at all or in general, because it's quite difficult during the last couple of months and even years. And I will answer or briefly answer that during the review of the ongoing strategies. But first to the question of profiles. It's quite simple. Maybe your screen would look like this one here. Quite easy. Nothing, only one chart. In my case, it's Euro, US dollar in an H4, so 4 hours chart, and nothing more. And maybe you have chosen already everything you like for this kind of chart. Chosen means I use candlesticks, not bar graphs, and so on and so on. Time frame, whatever you like. First is that you establish your screen for one single chart as you like. Maybe you want to have additional features like, for example, you want to have the ask line as well. And now this looks good. And then you might think, okay, in a typical chart I want to use, I want to have 2 indicators. And one may be a simple an exponential moving average, period 200, and you choose some color and so on and so on, maybe not that thick. And so we have one indicator in the graph as well. And the second indicator you want to have always in your chart might be the ATR. I don't know, let's say period 50. And now we have both. We have set up a single chart. So that was the first step. And what I now do is unfortunately this one here is in German, but anyhow, I want to use this here as a default setting for every chart. And therefore I can simply store it. And what's important, that you name it default. And the reason is, whenever you now open a new chart, it will always have exactly those looking. This looking with this indicator of EMA 200 and this ATR value. So that was the first step, just to create a default chart looking. So first step. Second step is now that you might be interested in 6 Forex pairs, like for example Euro, Australian dollar. So I simply open a new chart window for that, and you see already what I meant when I have this default chart. It opens up already looking exactly the same indicators and so on. And this I can now do maybe for 6 currencies, all related to Euro. And let's do it quickly. And now I have also 6. And then you can, for example, press this button with this multiple window symbol. And now you have your complete overview to all those 6 Forex pairs, which is, by the way, quite interesting to have always Euro against something, because now you have a good understanding, good general overview over the complete Forex market. Because if you think about, for example, the Forex pair US dollar against Japanese yen, of course, it's simply those 2 divided by each other. And so in principle, with those 6, you have 21 Forex pairs in one view, but you only have to look to those 6. And for example, whenever you see there's a strong trend upwards in one and a strong trend downwards in another pair, then you definitely know that if you look to that combination of those twos, then the trend is even stronger. So, by the way, that is one interesting additional information if you have this. And now all the charts are in H1, and I want to have this as a typical profile. And what I can do is I can, for example, store this profile like with a name, for example, Euro, well, let's call it this way, Euro XXX underscore H4. And now you can store it, and we can create another one just quite fast. Let's do it. We switch at every graph for M5, and then what we can do is we can store this profile once again and name it quite similar, store as, and let's have a look. I want to have this one, but now with M5. So that's all. And now I have created two sets of profiles, and in order to have one or each other, then I can simply select it here and go back to the other one as well. So that is the kind of profile in MT4, and you can set up different profiles, different, let's call it interests. Another interest might be, for example, just what you can do else here. You can have, for example, let's go for example, for gold, and you can create this one now 3 times and have them this way, and then maybe you can have this one on a daily base, this one on an H1 base, and this one on an M5 base. So now you have 3 one pro, or we can store it once again as a profile, that you have the gold price on 3 different time settings, and that might help you for your trading decisions. By the way, it's funny that H1 and M5 look pretty much the same, although it's a different time frame, but that's just by chance. So anyhow, so we can go for trading out of this kind of view, this multi-time frame view, directly for whatever strategy you have in mind. So that is about profiles. 2 things. One is you have that template, this default template for a single chart, and then you can set up your screen here in a way you like, and then you can store it under a profile name, and afterwards you can simply switch between those profiles very easy, because you can go back to this one, for example, and so on and so on. So that's about profiles in MT4. Good. The second question I will cover at the end, together with a review of 2 ongoing strategies. But now let's dig into entropy. Entropy and what does it mean? So you might have some memory about entropy from at school or at university. And normally entropy first enters in physics, and that is something which is well known in physics and used especially in thermodynamic. But what does it mean? In principle, and by the way, even I'm a physician, that is not the best definition here I use, and I know, but it's easier to describe it that way. Entropy is a measure of a disorder of a system. So the more disorder, the higher the entropy. So that's now the question is, what is really the meaning of disorder? But maybe let's go to the second line, and then I can make a simple example. So in physics, we call something, for example, closed systems. You can think about a room, a real closed room with no contact to the outside environment at all. Difficult to define or difficult to think about, but let's assume that. And then there is a general sentence in thermodynamics that entropy cannot decrease by its own. And the simple comparison is really quite easy. If you look for a room in your house, then you have a feeling of what does it mean if I talk about disorder. And what you normally observe is the disorder in your room increases more or less by itself. Of course, I know it's our own doing because we lay around some stuff here on the table and there. So, yeah, more or less the disorder, it looks a little bit in the room that the disorder increases by its own. And the other observation is, of course, you know as well, this room does not get ordered by its own. So this disorder always increases, and it needs some special action by your own in order to get the order back into that room. So this is a little bit of analogy in order to understand what does it mean if I talk about entropy in the context of physics. In information theory, there was one guy, the name is Shannon, I think about 50 years ago, he invented the concept of entropy or information entropy in the information theory as well. And there we have the good analogy that entropy in information theory is a measure of the information content. Of course, okay, we have to discuss what does it mean, content, information content. But we can show simple examples in order to understand what it means if I talk about information content. And the higher the entropy, the higher the information content. So that is, in principle, it's a complete one-to-one analogy to physics, but the latter is more related if I want to try to adopt the entropy concept to trading as well. But first, let's have a look to a simple example. I have a sequence of 0 and 1s. The first sequence with some zeros and some 1, and I have another sequence only containing zeros. And if you simply look to both sequences, then you can ask yourself which sequence has more content. And of course, the content of this one here is higher than for the other one. Also here we can find a good analogy in order to understand what does it mean to talk about entropy in terms of when it's related to, for example, simple numbers. In this case, I have only integer numbers. You can also think about that are simple bits, which are 0 or 1 and nothing else. And a good analogy in terms of thinking about bits or bytes is the question of how easy is it to compress that sequence. With compress, I mean really the same like zipping a data file, and not doing it really right now, and with such a short sequence, you would not really do it to compress my two sequences. But you can immediately have a feeling of which of those sequences can be better compressed. And of course, it's the one with all the zeros, because then I can use something, and that's, for example, also done by compressing algorithms. I can use things like, hey, now there come 10 zeros, and for this information I can have lower bytes, or the amount of bytes, to say something repeats here always. That's only one example. So if you have something which cannot be compressed anymore, then it contains maximum information, and it's, in terms of what is in there, is more or less now randomly. That is another statement you can do. If you have something which is totally random, then you cannot compress it by a single byte. So if you have a real random sequence of 0, 1, and so on, then you can't compress it. And that is a fundamental statement within information theory as well. But let's have a look to Wikipedia here in order to get a little bit more feeling about what does it really mean mathematically, talking about entropy. And a good example is that we first have a look on how it's calculated, and then have a practical example for throwing around coins, because that's a quite easy example to have access to the concept of entropy. And in principle, the entropy is calculated quite easy. You have to know how many states you have. That is, for example, this n here. And throwing around coins, n would be simply 2, because you can have either a number or a head. So you have only 2 possibilities. And now entropy is simply calculated by knowing the probability of the occurrence of the 1, and that's multiplied with the logarithm of the same probability. Sounds a little bit complicated, but if you get used to that kind of concept, it's only simple math and nothing else. So it's always the probability of one occurrence multiplied with a logarithm of the same. And in information theory, normally you do the logarithm to the base of 2, because then it's related to this, it's called Shannon entropy. Let's have a look on how this looks. And it's a quite simple graph, I know, but what is shown here in the graph, the y-axis, we have this called entropy, and on the x-axis we have they call it the fairness of the coin, which is quite easy to understand. Normally, every coin has a probability of 50% to be on the one side or on the other side, and of course this is so-called fair coin. Which has no edge, no bias for some certain side. However you can achieve that. But in this case, that means if you have this really fair coin, then the entropy is maximum, and this equals to 1. When you have this a little bit unfair coin, for example, in 30%, always you have the head side of the coin, then the entropy of that sequence you would get, of course, it would have more, let's call it 0. If 0 is the head, then we would have more 0 numbers in our sequence. And immediately that means that the entropy goes down. And ultimately it would be 0 if we have only, if always the same would happen. So always the numbers are always the head side of the coin. And you see already, if I go to the extreme, you understand immediately that this has to do with information content. Because if I always have only the one side of the coin, then it simply does not tell you anything. You know already the next throw, and you know the result. So if we go down here with the entropy, and now I come a little bit already to trading, the more predictive, the more not random is the overall behavior. So looking to already to translate the concept of entropy to trading is, what we don't want to have is situations which are absolutely random. Because if they are random in those kind of situations, it's hard to trade. What we look for is situations with lower entropy, because that means we are by far not that random in the price movements than if we have a complete random behavior. I can show you exactly that in a small Excel sheet, and once again, this is done by euro, US dollar, but only for simplicity, or just as an example. So as always, you know, we have the prices here. We have open, high, low, close, but I always, in this case, I only use now the close values. And what I have calculated here is simply, let me enlarge it a little bit. What I have calculated is simply the change, and the percentage change from one close of a candle to the next close of a candle, and nothing else. And in order to have it a little bit more simple, I do it in a similar way than throwing coins. I only ask for the sign of the change. So the sign could be either -1 or +1, and nothing else in between. And the question I ask now myself, looking back to some certain history, how often do I have the -1 and how often do I have the +1? And that's all. That's a complete question, and I'm not interested in any other information. I asked that kind of question simply, and that you see what I have done here. I have to go a little bit downwards in the Excel sheet. I come to the graph, and we look together to the graph once again. That you see what I have done. I calculated the probabilities of +1s and the probabilities of -1s. And doing so, I have not counted really the number of ones and the number of -1s. I use a small minor trick. I sum those values up, those 256 values. I sum them up, and that sum has values between -256, and if always it would have been a -1, and +256 if always it would have been a +1. So therefore I add 256, and then I divided that number by 512, so that I have the real probability of having a +1, within this last 256 candles, and that's all. And then I applied the same math like shown on the Wikipedia article. So you see the probability times the logarithm to the base of 2, and that for both the plus ones and the minus ones. And then we get a graph, and that graph is you have seen here already a little bit. And what is shown is two things. One in blue and with the left y-axis, that is the price itself. And this picture is running over 2 years only. I will show you pictures about over the last 10 years as well, but the Excel is getting extremely slow, so I have stored already those pictures, and we will have a look to them as well. And so in blue we have the price itself, and in red we have now this entropy. And of course the first you see is we are always extremely close to 1 means absolutely random. And that already is a hard statement. So even that we have only short periods when we go away from that random behavior, it's really only short periods. In most cases, we are close to 1, and close to 1 is nothing else than tossing around coins. But we see there are phases, time-wise, sorry, there might be something going wrong. Okay, now I'm back, I think. Audio and video should work once again. Sorry for the technical issue. Okay, now back. So first statement is in most time we have this more random behavior. We cannot see it directly within the chart because you don't see the single movements in between, because it's H1 based data, and that for 2 years, so you don't see it by your eyes. Especially if you look, for example, here in the middle, when we have 2 shorter periods going away from that random behavior, the price itself does not look, for my eye, that different from other situations. Okay, I see there are maxima within that period, but there are always other examples having maxima here. So a maximum is not an indicator that entropy goes down. But we see here in this case entropy sometimes goes down, and that could be something we can use for our trading. This is just an example how the principal concept works. Let me, and I hope I can find it that fast. Let me show you 3 pictures. And those 3 pictures I took from more or less the same Excel sheet already before. And the 3 pictures are now, I have to look, one, just a second, then I know it back. Okay, because I have no names within the picture. This is more or less the same picture we have had within my Excel sheet, but at that time we only looked for this period here, and you might remember there have been those 2 digs here, those 2 situations when we get lower values of entropy. And now we look to the complete set of 10 years with the concept of entropy, and you see from time to time we have that kind of behavior that entropy goes really down. That is those situations we can look for having better trading situations. That will not be the strategy I use later, but in principle I want to use that statement because in those phases we go away from that random behavior. So when we are not that close to one, we go away from the random behavior, and those situations are situations we might use for trading. This was the example looking back at 256 candles, and I have created another example here, and now I have simply looked 1024 candles backwards, and once again you see that there are always some periods when we go for a little bit lower values, but please keep in mind we are always close to one. It's only a small deviation from that random behavior. And when talking about random behavior, I have to at least mention that even if I go for a real random price curve, and this is that example, this price curve starts at 1, and the price curve itself is not anymore the euro US dollar. It's a random generated price curve and nothing else. But now applying the same concept of entropy, and even now knowing that we have random behavior, we see those small dips here as well, but they are not that large as compared to a real price like euro US dollar. So I have done a little bit analysis on that kind of comparisons. So what I can confirm out of those analysis is that yes, indeed, we sometimes, from time to time, we go more away from that one, meaning random behavior, than other situations. So we can use exactly that concept, and I will give you another example of entropy, and maybe that will help you additionally to explain what I simply mean with information and information gain, for example. And the other example is because I want to now to translate the kind of concept of entropy to the process of selecting an indicator, a good indicator. You know, in principle, we have hundreds of indicators we can use. And we have asked ourselves already last week, can we identify key values in order to measure the so-called predictive power, so that we know a current value of an indicator related, for example, to the price itself, or if we have indicators like stochastic, then we have always values between 0 and 1 or 0 and 100%. So all those kind of indicators we have and we know, and we have asked ourselves, can we find a way to identify whether the indicator has a little bit predictive power, so that we can foresee, at least with a certain probability, what might happen next. And we have done one kind of predictive power analysis last week via the so-called correlation, but there are situations where the concept of correlation does not work anymore, but the concept of entropy works always. And I'll show you what I mean with those two concepts. Let's start at first here. Let me guide you what I have here. And now it's getting a little bit abstract, I know. Think about that. I look, for example, 1,000 candles backwards, whatever. So 1,000 candles. I know those values and those changes and everything I know about those 1,000 candles. Let's assume I have an indicator And this indicator has only 5 potential values, integer numbers. 1, 2, 3, 4, 5. That's all. You can translate any real indicator out of, for example, MT4 into something which is then sorted to those 5 numbers, 1, 2, 3, 4, 5. It's only an assigning process. So you can think about, for example, this might be ATR, volatility, and 1 stands for low volatility, 5 stands for high volatility, and however you have defined it, then you have those 5 numbers. And then you might remember that we looked already last week to a potential that the good thing if we look to the history of data, we always know the future. That's fine. So what we can use for that kind of analysis, that we know the future, so that we know, for example, what potential changes, think about in percent change of the price value. Then those 5 numbers here maybe stand for -2%, -1%, no change, 1% change, and 2% change. Of course, this once again is simply assigning the real value numbers like 1.365%, but they are now sorted to those 5 values. And I have made here one example. By the way, this would be the ideal example anyhow. And let's assume within those 1,000 candles, we have 200 candles falling into the indicator category 1, and we know that always then the change, let's say for the next candle or next 10 candles, is always -2%. And we have 200 candles falling in the category 2, and always the change in future is -1. Of course, this would be an ideal situation, and everybody would know how to trade if we would find such a correlation in this way. We always have to measure the indicator value, and of course we would know going long, going short, and so on. So that is the ideal situation. And in this case, we could use the concept of correlation introduced last week in the same way, and we would find a very good correlation between the change in future and the indicator value. So in this case, I would not need entropy at all. I can do the job simply with correlation. Let's have another example. Nearly the same than the previous one, but now I do the assignment process. I have done it a little bit different, and I think you easily figure out that if you would do the correlation between the indicator values and the change in future, because I mixed those assigning here, the groups, then the correlation concept would not work, and we would not really see the predictive power of our indicator. Still, we have this predictive power, but that's only you have it, because you understand easily the kind of table I created here, and still you would know, okay, indicator has a value of 5, okay, I know what comes next, price goes down, and by 1%, by the way. Still you can do it, but the correlation would be more or less 0 between those 2 values. You have to try to figure it out by your own, and then you would easily understand. Going back to real situations. Real situations would mean in practice it would more look like a table like this one. Still, by the way, the table is simply done by pressing some numbers into the specific cells here, but you see a little bit of what I have done. If I go along one row, then I have for an indicator value 3. In 121 cases, the change in future has been -2. And in 13 cases, out of those 1,000 candles, I have, for example, once again, a -1 change. So you see, there's always a more or less clear maximum within a single row. That is done simply by putting those numbers exactly in that way into the table. But now I have a control number, and the control number is still the sum of all those probabilities is exactly 1,000. So not really probabilities; it's the number of occurrence. And now what I have done here is I calculated the entropy in the same manner than before by analyzing the euro-US dollar chart. You see, same formula, nothing else, and now simply then summing everything up, and then comes some normalization process, and the normalization process is necessary to have it always in a way that might be total random behavior equals to 1 in entropy, and that is, you have divided the sum. You have to divide the sum by the logarithm of the number of potential states, and the number of potential states in my case is 25 because I have 25 cells here. So this adds up to 0.89 entropy. Of course, it's a little bit far away from 1, so there is some information here. There is. We go away from the 1, so we go into a more ordered state, and that kind of state is indicating us, hey, that might be a good indicator. I've simply made a second example here, and in this example I choose those numbers more random, and what you see directly then the entropy goes up and goes close to 1 again. So we see that if you can do something like having indicator values, and in the history, of course, we always know the future, then we can set up those kind of tables, measure the entropy, and this entropy now helps us to answer the question, if we have 20 indicators, which indicator is better? And the answer is, the lower the value for entropy, the better the indicator is. And that helps us to set up a complete trading strategy. Let me describe how this is done. And I know today is a little bit complicated, but maybe you have to listen to the video once again, and it will help you to understand everything a little bit better. How do I set up a complete trading strategy out of what we have learned in the last 2 lessons? So what I've done is I create a set of indicators. Examples are EMA, slope of the EMA, or the distance of the close price from a given EMA. And then I have EMA values from, I don't know, 10, 20, 60, 100, and so on. So that gives me a long list of potential indicators. In my case, by the way, I use, I forgot the number, I think about 60 indicators. The change, the trend, strengths, something like that. And the concept of coming now to a complete trading strategy is quite simple. What I do is I look X candles, and you will see X is a number like 2000 on an H1 base, or 6000. By the way, 1000 H1 candles are about 40 days. So I look back this X number of candles, and what I try to do now, and what my computer is doing, is I will want to find two best indicators, the two best, with respect to the lowest entropy, having in mind if I have those with the lowest entropy, I have the highest predictive power of my indicators. Then I apply this class trading concept, because now I have two indicators having some numbers, and I have two indicators having those numbers. I set up those trading classes. You might remember one class might be identified with low values for EMA slope and high values in ATR, just as an example for one class. So I set up those classes, and for each individual class, I do now a process of varying the risk-reward ratios of trades and stop-loss values. So I really do trading in that history window. And what I do is I look for those risk-reward ratios and stop-loss values which are good for a profitable equity curve. So I look back those X candles and optimize a trading system for each class. By the way, in total I used 25 classes in this case. I have two indicators, and those indicators have values between 0 and 4, which means 5 different values, and therefore I have in total 25 classes. And for those 25 classes, I look to the history and looking what would be best traded how. And setting up those rules, I apply those rules for the next, now I go to the future, for the next Y candles. By the way, this method is called walk forward concept, or walk forward method, or backward forward testing, however you call it. And that kind of process I iterate through my complete set of data. By the way, there's one thing you have to be very careful here, and doing something like this, you have to be careful that whenever you look for the predictive power, or because there you in that calculation enters the future, that your window that you is set in a way that you never go out of your history window with your data, because otherwise you there would be already some future in that historical window, and then typically you get extremely good results, but of course they are not valid, because then the future has ended up in the optimization process. But that's only one remark. So we can iterate that process, and then everything is done by its own, because there's only 1 degree of freedom within that kind of concept. And that 1 degree of freedom is only the number of candles for the history and nothing else. And that is always good, that you have reduced your parameters, your degrees of freedom in a trading strategy. And that is the way I do strategy development for trading. And unfortunately, I can only show you some results, and the typical result looks like this here. Let me describe what you see here in this colored graph. First, the y-axis, the x-axis is a little bit strange. What you see here is more or less the date, but it's not the date like you are used to it. It's seconds after 1970. That is easier in doing this in that way, only because of computer reason. But in total, this starts at 2004 and ends up a couple of weeks back from today. So it's in total nearly 12 years data. And the different lines have different values for the backwards period. So how long is a period I look back into the history for always doing that kind of optimization process. I sometimes call it the back mirror window. And this differs from 1,000 candles up to 10,000 candles. You might remember 1,000 candles is 40 days. And then 10,000 H1 candles is 400 days, which is nearly 2 years of data around. And what do we have now? For example, going for the maximum curve here, the best line would be applying a history of 8,000 data points, and then derive our trading classes, trading strategies, optimization process, and always apply it to the future. And this is iteratively done in steps of 200, by the way, and then I get those equity curves. The y-axis, by the way, is in units of R. So the risk per trade, simply 1 R. And you see that the best value is 8,000 candles. Looking backwards, second best, the black one here, was 7,000. Then this red, I know there are 2 red lines here, but this red is the 10,000, then 9,000, and so on and so on. And still, of course, I realize we have equity lines really going south. But that's okay. I cannot expect that whatever I do, whatever history I take, that I get always profitable trading equity curves. One remark additionally, within that kind of trading, always commission spreads and so on are incorporated. So I use all those numbers as well. So it's real, let's call it real trading results, as real they can be. But because, for example, slippage I cannot simulate. But at least high values for spread and high values for commission are taken into account. And now I have already for one pair, that is US dollar Japanese yen, I know the equity line. And I would know what would be the best. But more, what I always look here is that adjacent equity lines, adjacent with respect to my history window, should be not that far away. And that is looking for always for those plateaus in the optimization process. But still, you have to keep in mind that I only have one single parameter which I can turn. And this one single parameter is only the history window size. And that's all. So for me, this is already quite promising. I know those drawdowns here within, I know them. But the hope is I do now the same job for 21 different forex pairs. And finally, I hope that I have a good equity curve for the combination of all of them, or at least for a selection of those. So that's what I will do in the next steps. I know concept was not that easy. Maybe you look once again to the video and to the concept of entropy. I hope then you will understand it finally, or you have understood it already, which would even be very nice for me as well. So now, already 12 o'clock, but nevertheless, I will have a quick view on two strategies which are traded by myself. And one is a so-called regression line, regression D1, which is based on a strategy which, I will show it directly, then it's easier to explain. Let me show it directly. You will see how the strategy works. Okay, there was this internet connection loss. And therefore I have to reopen the remote access to that server. And now we are back here. And you might easily realize how that strategy goes if you look to that chart here. You see there's a blue line within the chart, and this blue line is a simple regression line in those price values. And then if the close price from a certain from a D1 candle is far enough away from that regression line, then I open a trade, but only if I can open it into the direction of the regression line, or of the slope of the regression line. So the slope is, in this case, minus. So I only want to have short trades. So exactly in that situation here, we have close values being far enough away from the regression line, and then entering a short trade. So it's a type of mean reversion strategy. And I have performance values here, and this is the behavior for now. It's not 1 year, it's 9 months or so. And you see what happens. Okay, we have been going south and recovering a little bit, and now we are still in a flat region. So yeah, it's not that good up to now, but let's see what happens if something changes in the forex markets. I know then this strategy will recover once again. And I show you, and I'm always honest with those, another example, which is not running that good. You see, this is so-called forex fächer, which is multiple EMA. And it goes down over the last 5 months. Do I worried? The answer is only a little bit. And because I think I understood at least a little bit why we have that kind of situation. And the difficulty, and that was one final question someone asked me during the last week, and that is the difficulty of trading, forex trading, during the last couple of months and even years. And the difficulty, at least from my opinion, stems from maybe two statements. What are the main drivers for money flow between different currencies? Of course, I know those exchange rates are influenced by news and so on and so on. But the main drivers are changes in interest rates, so related to the federal banks, and B, to the changes in the economic situation of a specific region. And if you look back through the last couple of months, and now already even years, we don't have changes at all. we have really this stagnation process, so that we have no, or more or less no changes in the interest rates, and therefore there's no need for any money flow between the different currencies. And finally, what does it mean? Yeah, the forex prices, they simply wiggle around, and you might remember my chart of the €6 exchange rates against some other currencies. There is nothing. There happens nothing. And that is my strong belief that we need, once again, some changes, either in economic situations or in interest rates, and that will create new money flows between the currencies, and that will create much more not random behavior. Honestly, I cannot prove my statement, absolutely no, so it's only my thinking, and it's the short explanation of why Forex is really that difficult right now. But now already 6 minutes above time, I have to apologize. Here still the contact possibilities to me, to Argus FX. So whenever you have a question, just send me an email. It would be a pleasure for me to help you out. And maybe we can discuss some additional ideas as well. So that's for now. And hopefully we can see each other back next week, Thursday, 11 o'clock, same time. And I hope you enjoyed the webinar. Okay, thank you very much for your attention. Bye-bye.